third one. So budget deficit we have done, then fiscal deficit we have done, revenue deficit. Revenue deficit. So that name itself will tell you what is it, right? So revenue deficit means revenue expenditure minus revenue receipts. So revenue expenditure minus revenue receipts. Revenue expenditure means what? It is a day-to-day expenditure, the current consumption expenditure. Revenue receipts means what? Revenue receipts means the income. For example, if 120 crore is the revenue expenditure and let's say 100 crore is the income, what is the revenue deficit here? 20 crore. Now how can you meet this revenue deficit? You have to either borrow or you have to sell your assets. You have to sell your assets or you need to borrow, and this is actually a worst situation. So revenue deficit is worst. Why it is worst? Either you have to sell your assets or you need to borrow. It's like to meet your day-to-day expenditure, you need to sell your house or you need to sell your assets. So that is why it is considered as the worst expenditure. Okay. Now write one line you can write there. It shows total expenditure is more. That is why this concept of deficit itself is there. If there won't be any surplus budget in India's case. Okay, it is not possible for us country like India. It will be difficult. It will not be possible, and it is not desirable also. Surplus budget. We can say surplus budget will solve many issues, but not possible. One line you can write. It shows the extent of reduction in assets. It shows the extent of reduction in assets or increment in liability. So I hope you understood why you are writing this. I have told you if this deficit is there, how to manage it. You have only two way. Either you have to sell your asset or you have to borrow. So that is why I can say revenue deficit in this way also. Reduction in asset or increase in liability. Okay, so revenue deficit, instead of using this, I can define like this. Because anyway deficit you have to meet this, because these are day-to-day consumption expenditure. Okay, current consumption expenditure. So you can meet only in this way, like salaries and all this, right? So you can't skip that. So this is the only way. So right, it shows the extent of reduction in assets and or increment in liability of the government for meeting current consumption expenditure. For meeting the current consumption expenditure. It is a most undesirable concept. It is a most undesirable concept of budgetary deficit. It is a most undesirable concept of budgetary deficit from the perspective of economic development. From the perspective of economic development. Okay, now as per FRBM A 2003, the government has to eliminate revenue deficit by 2009. Okay, so what is the case in case of fiscal deficit? It should be reduced to 3%, but here this has to be eliminated. Okay, so as per FRBM, fiscal deficit has to be reduced to 3% by 2008. So here it has to be eliminated by 2009. This is a condition. Now one thing is there, you can see, except in this year the fiscal deficit and revenue deficit is actually reducing consistently. Okay, so there is an amendment that I will discuss soon, but I am just saying what is the actual provision. As per the amendment, this has to be kept as 2%. Okay, I will discuss the context of this amendment. Instead of eliminating, it has to be kept as 2%, and government actually introduced a concept of effective revenue deficit. I will be discussing about this effective revenue deficit now itself, but let me ask you one thing. Let's suppose, let's take these two cases. There is a fiscal deficit of, let's say, 3% and 6%. There is a revenue deficit of 3% and 0%. Okay, so who is doing better here, A or B? Country A, if you see, fiscal deficit is 3%, revenue deficit is 3%. Country B, if you see, fiscal deficit is so high, 6%, revenue deficit is 0%. Who's doing better? Country A or country B is better?
Sir, country A.
Actually, country B is better because there is a deficit for sure. Higher deficit is there. That means higher borrowing is there. Okay. Now, but these borrowings are used for what? No revenue deficit, no here. So all these borrowings are basically going to create some infrastructure or develop some assets. So these are capital expenditures. These borrowings are mainly going as capital expenditure. Borrowing is there, but that borrowing is not to meet the day-to-day expenditure. That is not for the current consumption expenditure. So borrowing is high, but this is actually going to create infrastructure. But here, even though less borrowing is there, all these are going as what? Revenue deficit. This is just to meet the current day-to-day consumption expenditure. So it's like you are selling your asset to meet the expenditure. Here you are borrowing, but you are creating equal assets. There is no problem. So in this context, this is better. This country is better, even though fiscal deficit is high. See, fiscal deficit high is not a big problem. The main problem is revenue deficit. Because revenue deficit means there is no asset creation. It is only for revenue expenditure you have to borrow. Revenue expenditure means what? The salaries, pensions, etc. So for interest payments, for that you need to borrow. That's the worst situation. Now, which one is easy? Reducing fiscal deficit or reducing revenue deficit? Which one is easy? Which one is easy for the government? You can take this example itself, you can tell. See, for this country B, if you see, it is very easy to reduce the 6 to 0 because entire deficit is on infrastructure assets. So if you prefer not to create this, it will be 0. Anyway, this is 0. But for A, fiscal deficit will be there. You cannot do anything because it is all revenue deficit. This cannot be changed, right? Because this is day-to-day expenditure. This has to be paid. There is no change which you can make with this. So revenue deficit, can you reduce? You cannot reduce. There is a big problem. You have to reduce the salary, you have to go for tax reforms, etc. Capital expenditure, if it is, you can reduce. So reducing fiscal deficit, what you can do? You can just reduce the capital expenditure. So reducing fiscal deficit is actually easy because you just need to reduce that infrastructure, okay, or developmental expenditure, capital expenditure. Okay, so reducing fiscal deficit is easy. Fiscal deficit reduction is easy compared to revenue deficit. So this is difficult. Why? Because these are related to salary, pension, etc. That can't be done anything. So here you can stop constructions or infrastructure, assets building, etc. So you don't want to borrow, and then you can reduce fiscal deficit. But revenue deficit is difficult. Next concept, effective revenue deficit. Just now I have told you government introduced a new concept by amending FRBM and making the revenue deficit to 2%. So introduced effective revenue deficit. So effective revenue deficit means you calculate the revenue deficit minus, see, in this revenue deficit the grants given to states will come. Correct? No? The grants will part of revenue deficit because there is no asset liability. We have discussed that. So grants given to states will come under revenue expenditure, right? Tell me, grants given to states will come under where? Revenue expenditure or capital expenditure? It is grants. There is no obligation. There is no liability. So it is revenue expenditure. Okay, so grants given to states will come under revenue expenditure. So that will be part of revenue deficit also anyway, because expenditure is so high. So you take that revenue deficit minus, see, some of the grants given to states, it is actually coming under this, but the state might have used it to create some assets, or state might have used this to capital expenditure. So that you need to exclude. So I can write here grants to states for capital expenditure. I hope you understood this. So revenue deficit minus revenue deficit means because revenue expenditure is high. The grants given to states are part of revenue expenditure, but we need to reduce that. That is when you can say effective revenue deficit, because some of that revenue expenditure is used to create some capital expenditure or capital or assets. So that has to be excluded. That is what effective revenue deficit, and amended and made it as effective revenue deficit to be 0. Next concept 5, primary deficit. Primary deficit. Primary deficit means fiscal deficit minus interest payments. So I've told you interest payment is coming around 20% of the budget, right? So around 1/5 is actually interest payments. So this is a primary deficit. Ignore that interest payment. So if you need to see different governments' performance, you need to calculate primary deficit, because the previous government's borrowing will come and affect the next government in terms of interest payment. So if 1/5 or 20% is going as interest payment, this government will face problem, right? So primary deficit concept. So fiscal deficit is nothing but the borrowing minus interest payments. That is primary deficit. So effective revenue deficit, don't be confused. Effective revenue deficit is revenue deficit minus grants. Okay, here fiscal deficit minus interest payment, revenue deficit minus grants, fiscal deficit minus interest payments. So no confusion here. Just write one line. It shows fiscal situation of the government. It shows fiscal situation of the government during the current financial year. During the current financial year, ignoring the impact of debt burden. Ignoring the impact of debt burden or borrowings of the past. Or borrowings of the past. So the past borrowings impact can be avoided when you exclude the interest payment. Okay, so it shows the fiscal situation of the government during the current financial year, ignoring the impact of debt burden of the past. Debt burden or the borrowings of the past. One more line. It shows the extent to which the government is further increasing or reducing debt burden of the past. It shows the extent to which the government is further increasing or reducing the debt burden of the past. Now, sixth concept, monetized deficit. Okay, monetized deficit means it's actually printing of money, printing of currency only. So in other words, what you can say this, monetized deficit, you are printing currency, deficit financing, right? So this is nothing but deficit financing, right? And the impact of deficit financing, I've told you last session that it won't create any asset, rather it transfer asset only. That we have discussed already. With example, I have told you how deficit financing, when government is printing more money, it the resources will be transferred from private to public. I have shown you with example. So just right there, it measures borrowings of the government from the central bank. Borrowings of the government from the central bank during a financial year. From the central bank during a financial year. So when you're borrowing from the central bank, that is what you call as deficit financing. Mostly the RBI will print currency and will give. But we have told you it has been stopped as per Washington consensus also, when we discussed about the first generation reform, and then as per FRBM Act also. Okay. Just write, that is increase in net central bank credit to the government. That is increase in net central bank credit to the government. One more line. It increases the quantity of reserve money, M0. It increases the quantity of reserve money. Just write this, Anjali and Sahar. We will see that later. In case if not possible, I've updated the video on monetary system. There you will get all these concepts, M0, M1, M2, etc. So it increases the quantity of reserve money, means printing of currency. In bracket you can write printing of currency. So M0 increase means what? M is the money multiplier, M0 is the reserve money. This is what money supply, right? So money supply will increase. When money is printed, money supply will increase, because printed money government is borrowing and ultimately coming to the market. So money supply will increase means what? The demand will increase, the prices will increase, inflation will be there. So I've told you printing of currency is highly inflationary. Many a time I've told you this, okay? So increase money supply by multiple magnitude. Multiple magnitude means what is the value of M? M value is 5.6. So government is printing 100 rupee, okay? What is the impact of this 100 rupee? 560 rupees actually the impact in the market. So that will create the problem. This is how monetized deficit, the deficit financing. Let's say I've told you this example, same example many times. In the market, let's suppose total 1000 rupees there, and in the market total 100 goods are there. So here if you see this 1000 rupee is chasing 100 goods. So one good will cost 10 rupee. So let's say in the public, the government it is 300, and from private it is 700 rupees there out of this 1000. So if one good is 10 rupee, the public government can buy how much? 30 goods, and private can buy how much? 70 goods. So total 100 goods have been sold like this. Now imagine government went for printing of currency. So let's say 400 rupee extra printed. So now in the market total 1400. This 1400 is chasing 100. So one good now cost 14 rupee. Okay. Now what will happen? This 300 in the government will become 700 because of this 400 extra, and this 700 will remain as 700. Okay. So government can buy 50 now, and private also can buy 50. So what actually happened here? Ultimately 100 good remain 100 good. There is no change in production. So there is no resource created. No resource created. What happened? Transfer of resource from private to public. 20 from here taken out, and so that is why reduction of 20, and given to state, the government. That is why increase of 20. So only transfer of resources actually happening. So you may say that you can print money and you can start hospitals, schools, etc. But ultimately what is actually happening when you are printing the money? It is actually resources transferred from private to public. It would have been there in the private only. May not be in health or education, but in some other way. Okay. But now it is going to be invested as health, education, etc. You may question that, but this is actually what's going to happen. Resources are not created. It is transferred. Now just write deficit financing. There are three components. It is similar to monetized deficit only, but technically when you talk about deficit financing, just write deficit financing. Deficit financing, just write three conditions or three components. There is only a minor difference, okay? So it is same as that of monetized deficit. Minor difference, and 2-3 components are not significant. So 3 components. First one, government borrowings from RBI. Government borrowing from RBI. What is this? This is what? Monetized deficit. So which one is broader? Deficit financing is broader, and monetized deficit is actually part of deficit financing. But second and third is not significant. So actually deficit financing is equal to government borrowing or the monetized deficit. That's why I have told you monetized deficit is nothing but deficit financing only. Second, printing of rupee 1 and small denomination coins by government. Printing of rupee 1 and small denomination coin by government of India. Third one, net withdrawal of cash by the government. Net withdrawal of cash by government from its account with RBI. So government's account, every government, state government, central government have to keep account with RBI. So from that, the net withdrawal of cash net withdrawal of cash by the government from RBI. So see, these two are not important, significant. So that's why I've told you, deficit financing means all these three are part of deficit financing, but these two are used as synonymous. Okay, so both are used as synonyms, or synonymously it is used. Both are almost same. Only this is the technical difference. If I ask you what is deficit financing, you should be in a position to tell that these three components, and in that monetized deficit is actually one of the component. So deficit financing is broader. Yeah, okay, can we stop now? We'll continue tomorrow. Tomorrow we will discuss about public expenditures. Very important topic. Last year also there was a question.